Today, the crypto world sees price movement. LTL sees what sits behind it. The story no chart shows, the pressure no headline names, and the architecture no retail holder realizes is being built beneath their feet. Because while XRP slipped back toward the $2 line today, while the crowd panicked at the red candles, the hidden network behind the internet of value quietly shifted into its next phase. Start with the surface. XRP lost over $19 billion in market cap this week, and trading volume fell more than 30%. A classic sign of fear, a sign the average holder feels the weight. And beneath that fear sits hard data. Only 58% of the entire XRP supply remains in profit. That leaves more than 40%, around 26.5 billion XRP, sitting at a loss. This is not random, this is structural. In every cycle before the next expansion, a large portion of supply must move underwater. It signals exhaustion, capitulation, and a reset of who actually controls the asset. But here is the part the crowd never sees. While retail bleeds, exchanges are draining. On several major exchanges, reserves have fallen to the lowest levels in almost 20 months. Some snapshots show around 3 billion XRP total left on supported platforms. One 24-hour window saw more than 149 million XRP leave exchanges altogether. This is not selling. This is removal. This is migration to cold storage, custody, and institutional rails. The type of movement that does not return until the structure is ready. Liquidity is quietly thinning, like a spring being compressed, preparing for its release. At the same time, whales are moving in the opposite direction. More than 200 million XRP shifted onto exchanges in the last 48 hours. That is not panic. That is strategic distribution, a controlled rebalancing. When combined with falling supply on exchanges, it forms a perfect market illusion. Retail sees weakness. Institutions see opportunity. Then comes the headline the world missed while staring at the price. The first major US spot XRP ETF launched. Bitwise brought the XRP ticker to the New York Stock Exchange, a regulated rail tied directly into legacy finance. Analysts project these ETFs could absorb more than 22 billion XRP within a year, and almost 40 billion in a second wave. When supply on exchanges is already at a 20-month low, this should not just be a headline. It is the beginning of a supply war. Look deeper. Network activity shows anxiety. Daily active addresses down 9% month over month. NVT ratio snapping down more than 50% in a single day. Sentiment weakening. This is the emotional fog that forms before large structural shifts. The crowd goes numb right before the rails turn on. All the while, tokenization expands through the XRPL ecosystem. Real-world assets, payments infrastructure, and settlement layers quietly grow, while the market cares only about candles. This is the separation phase, where fundamentals and price disconnect, where the hidden players build and the public sleeps. Here's the truth LTL calls out today. XRP is not in decline. XRP is in compression, a phase where loss-heavy holders are shaken out. Supply drains from public markets, institutions step in through regulated ETF rails, and infrastructure expands while no one pays attention. When the tides shift, the supply will not be there, the liquidity will not be there, and the architecture will already be built. This is the quiet storm. The moment before expansion, the chapter the world ignores until the next breakout makes everyone ask how it happened. But you heard it here first. This is LTL Productions, and this is the story behind today's XRP news.